In this video, we're going to talk about the differences between the credit vertical spread as well as the debit vertical spread. We're going to be addressing the question of which one do we use and under what circumstances. A vertical spread is an option trading strategy that's made up of two options contracts with the same expiration date. To execute a credit vertical spread, we will sell one out of the money option contract and simultaneously we will buy another out of the money contract that is further away as protection. Because the option that we sold is more expensive than the option that we bought, therefore we will receive a credit for executing this strategy. The goal here is for both option contracts to expire worthless by expiration date. To execute a debit vertical spread, we will buy one option contract. The strike price is really close to the current stock price, and simultaneously we will sell one option contract out of the money that is further away from the current stock price. Now, because the option contract that we buy is more expensive than the option contract that we sell, therefore for this trade we will incur a cost or a debit. For debit vertical spreads, the goal here is for the option contract that we bought to increase in value faster than the option contract that we sold. If we're expecting an increase in the stock price, the credit vertical spread we can use is known as a bull put spread, and this is executed using two put options. The debit vertical spread we can use is known as a bull call spread, and this is executed using two call options. If we're expecting a fall in the stock prices, the credit vertical spread we can use is known as a bear call spread, and this is executed using two call options. The debit vertical spread that we can use is known as a bear put spread, and this is executed using two put options. Before we go any further, let me just state that in no way am I saying that vertical spreads are the ideal perfect solution for any and every situation. There are many option strategies available that can be applied in different situations. For the purpose of this video, we're just comparing the differences between credit vertical spreads and debit vertical spreads so we can get a better understanding of the principles and concepts before we move on to some of these more advanced strategies. And we will be talking about these strategies, so make sure you are subscribed. Alright, so now we're going to take a look at this comparison using an example. But for this video, I'm just going to be talking about one direction. Pretty much the concepts is the same for the opposite direction, you just need to reverse the options that are being used. So this is our example, and just for illustrative purposes, maybe I am bullish on this particular stock. So if I'm bullish and I would like to use a credit vertical spread, I will use a bull put spread. So first of all, I will sell an out of the money put option. Maybe I will choose the $62.50 strike price with 40 days to expiration. For selling this put option, I will collect a premium of $171. At the same time, I will buy another out of the money put option as protection. So perhaps I choose the strike price of $60, also with 40 days to expiration. To buy this option, I have to pay $109. So all in all, I collect a premium of $62, and that makes my maximum gain on this trade $62 and my maximum risk on this trade $188. If I'm correct, this will give me a maximum return of 33% over 40 days. If I want to use a debit vertical spread instead, the strategy I will use is a bull call spread. Now, first of all, I will buy a call option with a strike price that is very close to the current market price. So perhaps I choose the $65 strike price with 94 days to expiration. So to buy this 65 call option, that will cost me $510. Now at the same time, I will sell another call option that is further out of the money. Perhaps I'll choose the option contract with the strike price of $75 because there may be a potential resistance here. And for selling this option contract, I will receive a premium of $145. So all in all, for the bull call spread, I will pay $365, which is also my maximum risk. If I am correct, effectively I have the rights to buy the share at $65 and the obligation to sell the shares at $75. So this will make the maximum potential gain on this trade $635. And that gives me a maximum potential return of 174% over 94 days. Alright, so now we have our two vertical spread positions. What do we see when we compare them? Now, first of all, both of these positions have limited risk. They both have a defined maximum loss, and they both also have a maximum amount of potential gain. I think the most obvious difference here is that the debit vertical spread clearly has a much higher potential return. Also, what we see is that the return to risk ratio of the debit vertical spread is much higher than that for the credit vertical spread, in that the maximum potential gain is higher than the maximum potential loss. Now, these two factors may lead some people to say, hey, the debit spread looks like a much better and more attractive deal than the credit spread. But is that true? To answer that, let's explore the potential outcome of both positions. For the bull put spread, I will incur the maximum gain if the stock price remains above $62.50 by the expiration date. I will incur the maximum loss if the share price falls below $60 by the expiration date. The share price can do whatever it wants. It can go up, it can stay the same, it can even come down. But as long as it stays above $62.50 by expiration date, I will make the maximum gain. Now, what are the chances of that happening? The $62.50 put option that I sold has a delta of 0.3, and that means that I have a 70% chance of making the maximum gain. The put option with a strike price of $60 has a delta of 0.2, which means that I have a 20% chance of incurring the maximum loss. And the remaining 10% is whatever is in between the max gain and the max loss. Now, what about the bull call spread? In this scenario, I will only make the max gain if the share price increases above $75 by the expiration date. I will incur the maximum loss if the share price is below $65 by the expiration date. The $75 call option which I sold has a delta of 0.03, which means that statistically I only have a 3% chance of making the maximum gain. Whereas the $65 call option which I bought has a delta of 0.58, which means that I have a 42% chance of incurring the maximum loss. So yes, even though the debit spread has a much higher potential return and a much higher reward to risk ratio, the odds of earning those returns is not that great. So what we see here is that if we want to trade debit vertical spreads, if we want to make those higher returns, we have to be very convinced and almost very sure that the stock price is going to move in our favor, because the statistical odds of this trade is not in our favor. Whereas if we trade credit vertical spreads, we don't have to be as certain about the direction. Now, credit vertical spreads is an option selling strategy. So the aim and the benefits of trading them are the high probability of success, as well as the ability to put time decay and volatility contraction in our favor. So we should look to sell credit vertical spreads when volatility is high, so we can benefit the most from volatility contraction. Whereas debit vertical spreads are net option buying strategies, so they are more likely to benefit from an expansion in volatility. So if we want to trade debit vertical spreads, we should look to trade them when volatility is not high. You can check out my video on volatility and the IVR for more information. So there we have it. These are the different kinds of vertical spreads that we can use based on the direction we think the stock price is going to move. And when we have an idea of direction, these are the considerations to take into account when deciding whether to use a credit or debit vertical spread. So that's all for today's video. I hope it was helpful for understanding the basic differences between credit vertical spreads and debit vertical spreads. Do like, comment, subscribe if you found it so, and I will see you in the next video.